10 o'clock. We are here at 335 Adams Street at NYCERS Conference Room in Brooklyn. And Madam Executive Director, would you please call the roll?
Okay, Chair.
Here.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn.
Here.
Borough President Queens.
Here.
Borough President Staten Island.
Here.
Borough President Bronx.
Here.
International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Here.
We have a quorum.
Thank you very much. You have before you on pages 1 and 2 the proposed draft agenda for today's meeting. Does anybody have any changes, additions to the agenda? Okay. Do we have a motion to adopt today's agenda? Yes. Pat, do we have a second? Thank you. All in favor? Okay. Any opposed?
No.
All right. Thank you. So the first item on the agenda is this December monthly performance review, which you should have in front of you.
And we have extras.
Thank you. So Seema?
Okay. Thank you. So before we get into the December numbers, which seems like a long time ago now, and we'll go through a little bit about January, I wanted just to give a little backdrop on what's been going on that I'm sure many of you have read about and heard about. But January was a very tough month in the markets. Both U.S., non-U.S. equities had a tough time, as you'll see when we go through those numbers. Basically, there's been concerns over China slowing. Emerging market currencies, many of which took a big steep decline in the month of January. A lot of uncertainty going on. The Fed continues to taper their bond purchases, so they've now gone from $85 billion a month to $75 billion a month to now $65 billion a month. Of course, the debt ceiling debate in Congress was coming up in February, but I can tell you now that we're in February, that has been resolved, so that's actually a good thing. And within all this, talk and noise and uncertainty, the economy is actually doing okay. So I would ask you to turn to page 3 in your book, and we'll talk a little bit about some of the key statistics that we look at as we think about how we're doing. So this is the ISM Manufacturing Index. And you'll notice that if you scroll right to the right, the far right, you see in December it spiked actually up to the 57 level. It's now down to about 51.3, but really anything above 50 is showing expansion in the economy. So that's a good sign. If you then turn to page 5, this shows the unemployment rate. And you'll see that this chart has been declining down to now we're at 6.6% unemployment. Now, there's been lots of debate, though, around that number, as the Fed had said, well, once we get to 6.5% unemployment, we'll start thinking about raising interest rates. They've definitely backed off of that because this number, many have argued, that doesn't quite fully take into account those that are not yet looking for work anymore. So the participation rate has gone down. So the Fed has now backed off of this 6.5%. And so while we look at this number, we have to keep watch on what the Fed may or may not do with interest rates. At this point, we don't think they're going to raise based on that number. If you then turn to page 18, this is called the Volatility Index, the VIX. Basically is the sense of nervousness and anxiety in the market. So if you look around the December time frame here, far to the right, it spiked into the 20s. Hadn't done that in a while, as you can see. Now it's back down to 13.5, now that we're sitting here in February. But that spike was all along the lines of all this uncertainty out in the marketplace, and it's now since come down as some of these things have resolved itself. The new Fed chair coming on board, Janet Yellen, that was yet another thing that people were uncertain about. Which way is she going to go? Is she going to continue on the path that Ben Bernanke took? Is she going to change her view? I think what we've learned now is she's going to keep steady as she goes and not quite shake the system at any point soon. If you then turn to page 20, another indicator of where we are and uncertainty out there and how things are right now. This is the 10-year Treasury. And so, again, if you look to the far right, you'll see it spiked late last year up to 3%. It came down pretty hard, approaching 2.6%, and now it's back up to 2.7%. So again, you know, we went from this, the rates going up, that actually is good for the economy, and then we get worried about the economy again, and the rates start coming back again. And now we're starting to tick back up again. So again, I think what we'll expect is some choppy waters as we go through the early part of the year for sure, particularly in the U.S. stock market and the international stock markets. But that's sort of the basic backdrop to what we'll then show you as far as the numbers go. They'll make more sense, I think. So if you turn to page 27, we'll just go through what the December numbers look like. And December was a very good month. So you'll see the Russell 3000 index, which is basically your U.S. stock market, up 2.64%. Scroll down a little bit more to the MSCI EAFE, which is your developed market, non-U.S. That's up 1.5%. One down below is the emerging markets index, down 1.45%. You go down several rows more and you see the Core Plus 5, down about 60 basis points. Down a little further is high yield, which was up about 55 basis points. TIPS down nearly 1.5%. And then convertibles up 1.95%. So good month in December. So now if you turn to the next page, here's what January looked like. So you look at the Russell 3000, down 3.16%. MSCI EAFE down 4%. The emerging markets index down 6.5%. You go down below, the Core Plus 5 is now up 1.68%. The high yield index up about 75 basis points. TIPS up nearly 2%. And convertibles up 1.9%. So if you then turn to page 34, we'll go back to December and we'll see where we made our money. This is the contribution to return page. So look at the far left bar, the 1 month return for December. The fund was up about 1%. You scroll over a couple columns, you'll see the fiscal year to date. That's through December now. Up 10%, which is a very strong number. Now, when you factor in January, which we estimate we're down about 2%, we're still up 8% fiscal year to date through January. I mean, January is a very rocky month. So again, still a very strong number as we look through January. I can tell you now in February is a stronger month in the market, but again, we'll see how this plays out. There's still a lot of rockiness. I can tell you though, the assets under management for NYCERS as of February 20th, again giving you a sense for what January is like, the fund is at $50.9 billion. So even through this rockiness, the fund is still where it is, which I think is a very good indication for the fund. So if there aren't any questions, that will complete our portion of the public session.
Do we have any questions? Thank you.
Okay.
Do we have a motion to enter executive session? Do we have a second? Thank you, Ray. All in favor? Aye. Any opposed? Okay, thank you. It'll take just a couple of seconds to break down the cameras.